Hello everyone, welcome to our Egyptian online seminar group. First, questions of then if you have any questions, we can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor John Gallemore. John is an associate professor of accounting at the University of North Carolina. He studies how firms' economy and the financial reporting behavior are shaped by corporate tax policy and enforcement. His research has been published in top-ranking journals such as the Journal of Accounting Research, Journal of and Economics, the Accounting Review, Review of Accounting Studies, Management Science, and Contemporary Accounting Research. He is an associate editor for the Journal of Accounting and Economics and is a member of the editorial board of the Accounting Review. Now we will start our seminar with dear Professor John Gallemore.
Hi. Yeah, thanks, Mohammed, for this invitation to present. Thank you all for attending on your Friday evening or Friday morning, wherever you are. Yeah, so I'm going to be presenting joint research with Stefan Hollander, Martin Jakob, and Sean Zhang. So this is a paper that we've it's a rare paper that I'm as excited about today as I was when I started working on it several years ago. That's not, those of you in research know that that's not too common, but I'm still excited about this paper, which is forthcoming at the Journal of Accounting Research. So let's see, get the clicking working here. There we go. Cool. So just to kind of set the stage for what we do in this paper, there's an extensive literature that examines how tax policy shapes firm investment behavior. So I cite a few of the papers here, but this is a literature that goes back multiple decades. One interesting thing about this literature is that it, generally speaking, assumes that kind of tax policy shocks happen kind of out of the blue. Which sometimes that may characterize tax policy changes, but for the most part, there's a process, an ongoing process that leads to changes in tax policies. And given that there are a series of events that lead to a change in tax policy, it seems reasonable that managers may be forming expectations, both prior to and after tax policy changes about the future path of tax policy. And this sort of thinking is, generally speaking, absent from this prior literature and potentially could be important, as I'll explain here momentarily. So we're going to label this construct, these perceptions that managers have about the future path of tax policy as tax policy expectations, or sometimes we'll abbreviate them TPE. So really what this paper is going to do is we're going to explore whether key policy-related events indeed shape firms' tax policy expectations, at least in a measurable and detectable way. We'll then explore whether these expectations have a material impact in investment. And then finally, we'll explore whether both of these things, the impact of the events on the expectations and the expectations effect on investment, whether these vary across firms. Okay. So again, we're going to be focusing on these tax policy expectations. We think that this is an important topic. On the academic side, we think that our paper is relevant given this the theoretical critique in Hennessy Strabilev 2020 in the Journal of Finance. So basically what they point out, again, using sort of an analytical approach, is that expectations that managers have over policy can impact the causal inferences that an accounting researcher or a researcher in general would want to take away from analyzing a policy change. So let me illustrate that just very briefly with an example. Let's say that the general consensus in the economy is that the tax rate was going to increase from, let's say, 20% to 30%. And so people are forming expectations about what that future tax policy is going to be. They maybe start cutting back on investment because there's going to be a higher tax rate in the future. which is going to reduce the net present value of those investment opportunities. So they'll start to dial back on investment. Now, let's say that the tax rate does end up increasing, but it only ends up increasing from 20% to 22%. A well-intentioned researcher who examines the investment immediately before that tax rate increase and immediately after may find that investment actually increases, all right? And the reason they might find it increases is because the firms had previously been expecting a 30% tax rate, all right, and dialed back their investment accordingly. But now the tax rate increase only was to 2 percentage points to 22%. And so as a result, the tax rate expectations for managers has declined, making it more profitable to engage in these investment opportunities. But a researcher that is not measuring these expectations may say, oh, that tax rate increase led to an increase in investment. So having the complete wrong sign. And so this just illustrates the potential for these tax policy expectations to be basically like a correlated emitted variable in the analysis of tax policy changes. Yes, Nathan.
Hey, John, really like that example that you gave there. And I think when I think about this tax policy expectations, I think one thing I always think about is how like tax policy is this like very big umbrella where, you know, if you're like a local bank, you only worry about like what's going on in Raleigh, North Carolina. But if you're, you know, an Apple or Google, you're like the tax policy that you have to worry about is so vast. How do you all like think about like, how do you try to contextualize how companies are thinking about tax policy and what effects can be happening on these like large global companies?
Yeah, so that's a really good question. I mean, so one thing that you touched on in your question there is, you know, the differences, the heterogeneity across firms, and then their exposure to tax policy. So, for example, I'm here in North Carolina. We're both here in North Carolina, and there are local firms that may primarily operate in the U.S. or even in the Southeast or North Carolina. Those firms are going to be primarily exposed to tax policy changes and the expectations of those changes that are happening in North Carolina, right? Specific or more regional. Versus, you know, you think about a global company like Apple. They're not thinking just about tax policy in California or the US, they're thinking about tax policy in every single jurisdiction that they operate. And so for us, that's actually going to be, and I'll talk more about it here in just a second, that's going to be a key innovation, I think, of what we're doing relative to what prior research is doing. So in this next point here, you know, I mentioned that, you know, generally speaking, the literatures the tax literatures overlooked these expectations. Now, some of the papers do think about expectations, but they think about, or they assume that these expectations are effectively homogeneous, the same across all firms, missing the types of heterogeneity that you just talked about, right? Which is that it's probably not a plausible assumption to think that a local firm that's operating in one state and in one country is thinking about tax policy and how it might evolve the same as a multinational company that's operating in 100 different tax jurisdictions. So we're going to be taking a broad view of tax policy, not drilling down to any particular specific proposal or jurisdiction. But we think that in doing so, our construct and our measure is going to capture a more realistic view about how firms think about tax policy. And we do think our approach could be used to then drill down to specific jurisdictions and specific policies. So we don't do that, at least in this initial paper, but we think it could. Does that help? Yeah, great. Cool. So we think on the academic side, these expectations are potentially important. We also think they're important from the policymaker perspective as well. So at least here in the US, we have policymakers engaging in certain, let's call them behaviors and setting of tax policy. For example, we have the use of sunsetting provisions. The reason why we have sunsetting tax provisions is complicated, but basically we have parts of tax policy that we enact at a particular time, and they're scheduled to expire sometime later, usually within 10 years. And then for that tax policy to be maintained, the future government has to go in and renew those tax policies. Now, the issue with that from the firm perspective is now there's uncertainty here over whether or not this tax policy that's in place today is going to be that policy in place tomorrow, because that depends on the government that's in place tomorrow be a supporter of that tax policy and being willing to renew it. And so we think that policymakers may be engaging in these types of behaviors that then influence these expectations for firms. And if that has an impact on firm behavior, then there's going to be real economic consequences for those expectations. So that's why we think it's important. But let me step back now and talk about what we mean by tax policy expectations to make this a little bit more concrete. So we're thinking about this in a statistical sense. Anytime there's a tax policy relevant shock, all right, there's going to be some expectations, and we think that those expectations about a shock can be decomposed into two moments. The first moment, the mean, and the variance, the second moment. We're going to try to measure both of those, but at the construct level, we're going to think about this first moment as capturing information about the mean of a tax policy relevant shock as it pertains to the firm's future after tax cash flows. And that feels very abstract. So let me make it a little bit more concrete with an example. So let's say there's an election that results in a corporation-friendly party gaining control of the branches of government, right? Even though tax policy has not changed yet, firms might perceive that the likelihood of a tax rate cut or some sort of investment credit policy will increase, right? And so they're starting to now think about how that's going to impact their future cash flows from the investment, and they're now reducing the tax rate they're using in those estimates. So that's what we're thinking about with the first moment. And we're going to label this tax policy sentiment. Now, I know sentiment has different contexts, different meanings in different contexts. We're just using sentiment because like the first moment, it can be both positive or negative. It can increase or decrease. So that's why we're using this term sentiment here. So that's the first moment. The second moment is going to capture information about the uncertainty of tax policy. It relates to the firm's after-tax cash flow. So here we're thinking of like a discount rate effect. An example here would be, for example, the expiring tax policies that I talked about earlier, or an unexpected election outcome happening, all of a sudden increasing the likelihood that something might change about tax policy. And that in turn should make firms more uncertain about the tax rate that they're using when they're evaluating the NPVs of their investment projects. And so increasing that discount rate and reducing the profitability of those investment opportunities. So we're going to label this second moment the tax policy uncertainty construct. Now, to measurement. So in terms of measuring policy expectations, there have been several approaches that have been used in prior research. I'm going to broadly characterize them as method 1 and 2. So method 1 would be just to assume that expectations exist. So one way that papers have done this is to assume that certain macro level events give rise to certain expectations. And the most common approach to doing that would be to look around elections. So the idea there is that before an election, we don't know what the outcome is going to be. So uncertainty is going to be higher about what the future path of tax policy is. After the election, the uncertainty should be resolved, and therefore uncertainty will go away. Other papers have used economy-wide indices. So here I'm thinking like the Baker, Bloom, and Davis paper that tries to measure expectations using newspaper articles. So when you think about like the trade-offs of this approach of assuming expectations, on the one hand, these are pretty straightforward approaches. They're fairly easy to implement. The disadvantages are, in our view, well, it might not be correct, and we'll come back to that later. And then 2, it assumes that all firms have the same expectations at a given point in time. And we're also going to challenge that assumption in our paper. The second method, broadly speaking, are surveys. This has been used quite a bit in the literature studying inflation. So we're thinking like monetary policy. The nice thing about a survey is that when you send out a survey and someone responds to you, you know what their expectations were at that moment in time, assuming they're not lying to you. The disadvantages are that surveys are costly to implement, especially for large samples. And then specifically, if you wanted to study how the expectations affected firms' responses to event 10, 15, 20 years ago, not very feasible to go back in time and issue a survey to elicit those expectations. And you could survey them now, but people may not remember correctly what their actual policy expectations were around the time of those events. So these are the two methods that have been used in prior research, and they've got some advantages, but also, we think, some disadvantages. So our innovation in this context is going to be to adapt a methodology developed by Hassan Hollander, Tahuna and Van Lint in QGAE, where they analyze the discussions that take place in quarterly earnings conference calls using the transcripts. So a high-level overview of what they're doing, and I encourage you to go read their paper in the QGAE if you're interested in learning more. It's really fascinating. What they're going to do is they're going to develop a methodology for classifying bigrams. Bigrams are two-word phrases, and classifying them as to whether or not they refer to specific types of policy, including tax policy. So they'll have like a set of bigrams that they say these are bigrams are related to tax policy. Then what they're going to do, again, they mostly focus on the aggregate policy rather than drilling down on these specific types. But then they're going to then look around the discussions of those bigrams in the quarterly earnings conference calls and look for words, uncertainty synonyms in proximity to those bigrams. And then they're going to quantify that as being, hey, there's uncertainty about policy here, right? That this firm is expressing uncertainty about policy. We're going to use that approach to measure our tax policy uncertainty measure. So again, looking for effectively discussions of tax policy in these conference calls that are surrounded by words that indicate that the firm is uncertain. We're also going to do something similar for tax policy sentiment. There, again, we're going to identify these discussions of tax policy in the conference calls, and then we're going to look for tone words. So words that indicate positive or negative perceptions, right? And that's going to be our measure of tax policy sentiment. So just to be clear, we think there's some advantages and some drawbacks to this approach. We think that the advantages are nice. Relative to surveys, low cost, and you can get this for a large sample of firms. You can get historical expectations as well, as long as you have the quarterly earnings conference calls, which our data goes back up to 22, 23 years. There's a clear disadvantage here, which is that this is not going to be as good as a survey, right? Because it's going to rely on these firms talking about these tax policy expectations in their conference calls, and not all firms do. As it turns out, though, we think that there's value here in this approach, because as it turns out, you go look at the conference calls, they do talk about tax policy and their expectations over tax policy. So here is an example, is Pfizer. What I've done here in the graphs, I've plotted two lines. The black line indicates the quantitative measure of tax policy uncertainty, and the grayer line indicates that it's the quantitative measure of their tax policy sentiment. So we've plotted that in event time around our setting, and then we've also gone and looked in the conference call to see are these measures seemingly picking up on things, and the answer is yeah, they are. So for example, in 2017, in Q1 2017, there was some discussion in the US about a border tax proposal that was going to disadvantage, in particular, multinational drug companies. And sure enough, we see them talking about that in their conference call, and we see that the tax policy sentiment measure dips around that time period, suggesting that they thought that this was probably a negative thing from their perspective regarding tax policy. I think it's Q2 2017, so this is just after the election, there was lots of uncertainty about what was actually going to happen with tax policy in the US. The measure for Pfizer spikes in that period, and going and looking at their conference call, sure enough, they talk about, hey, there's uncertainty in Washington about tax reform and what it might do in terms of our investment plans. And so we're sort of in a holding pattern, is what they're saying. So again, what we think is really nice about this measure is that we can measure it for every single firm, right? And I just want to draw a contrast here with the prior literature. The prior literature that does look at expectations assumes that all firms at a given period of time have the same expectations, right? We don't think that that's potentially a great assumption, okay? And so our measure and our construct is going to be firm specific, all right? And this comes from this idea that the perceptions regarding tax policy at any given point in time for any given firm can vary, despite everyone having access to the same public information. That variation can come from a number of different sources. It can come from the business model, right? So this would be related to Nathan's comment earlier, right? So some firms, because of their business, operate in only one tax jurisdiction. Therefore, they're only going to be exposed to the tax policy expectations for that jurisdictions. Others may be exposed to multiple jurisdictions, right? Another aspect of business model that might matter here would be let's say, uncertainty over a tax credit related to research and development. So, so a firm, let's say that there's uncertainty about whether a R&D tax credit will be passed. Well, a firm that is an innovative firm that's engaging in lots of R&D, they're going to be exposed to that uncertainty. It's going to be very important for them. But a firm that's not engaged in any innovation, like a simple manufacturing firm, they're not going to be worried about the uncertainty over that tax policy. So again, at a given point in time, one firm may have uncertainty, another may not. Even holding that business model constant, though, different firms may have different private information about the future path of tax policy. And that may come from their connections to legislatures, their lobbying efforts, their involvement in different industry trade groups that provide them with information about what's going to happen with tax policy. And finally, there's just idiosyncratic characteristics across firms, such as managers having partisan leanings or overconfidence. Prior literature has shown that both of those exist and have important impacts on firm behaviors. So all this is to say that we think it's unlikely that a specific tax policy shock is going to lead to the same expectations across all firms. So again, going back now to our agenda, there's not a lot of research on these expectations. We're going to explore how these expectations evolve around policy-related events, how they shape investment decisions, and whether critically these investment responses to the expectations vary across firms. And our setting, which I'll talk a little bit more about here in a second, is going to be the 2016 election and the subsequent Tax Cuts and Jobs Act that was passed the next year, which is the biggest tax reform in the U.S. in over 30 years. Okay. So to quickly highlight the findings, and then I'll delve a little bit more into the measurement and the actual results that we have in the paper. First, we're going to find that our approach does seem to pick up the fact that these expectations vary around tax policy relevant events. Now, that may not be particularly surprising, but where we think this gets more interesting is that the patterns that we document, at least in our setting, run counter to the assumptions in prior work. So again, as I mentioned earlier, some of the prior work here says, hey, we're going to assume that the uncertainty is increasing in the run-up to an election and then decreases afterwards. In our setting, we find that uncertainty was actually quite low in the run-up to the 2016 election and then spikes afterwards. And I'll talk more about why that's a reasonable pattern results here in a second. So again, just showing you that these assumptions in prior work, yeah, maybe they hold sometimes, but they don't always have to hold. And so that's why we think there's value in actually trying to measure these expectations rather than assuming them. We also find that these expectations vary significantly across firms. And again, sort of contrasting with the prior research and their approaches, which basically assume that all firms hold the same expectations at the same time. Our second main finding is going to be that these expectations materially affect investment around our two events. So when firms are more positive about the future path of tax policy, that sentiment value is higher, they're going to increase investment. When uncertainty is higher, they're less sure about what that future tax policy path is, they're going to decrease investment. Building on that, what we'll do next is we're going to try to now see whether these expectations explain whether firms invested or did not invest around the Tax Cuts and Jobs Act. So here what we're going to do is we're going to classify firms based on the extent to which we think they were likely to benefit from the Tax Cuts and Jobs Act based on the observables. So what I mean by that is we're going to look at, like, for example, their effective tax rate. The Tax Cuts and Jobs Act led to a cut in the statutory tax rate. The firms that should benefit most from that are the ones that were paying a high tax rate before. So we're going to have a couple of these measures, and we're going to say we're going to focus on a subset of firms that we think should have benefited a lot from the Tax Cuts and Jobs Act and thus invested a lot after the TCJA. What we're going to find here is that there's variation in the extent to which these firms invested in after the TCJA, and that this is driven, at least in part, by their expectations. So, for example, the firms whose tax policy and sentiment increased the most after the TCJA, so they felt that the TCJA had this like long-lasting positive impact on the future path of tax policy, they invest substantially more than the average high TCJA benefit firm. In contrast, there are some of these firms, these expected benefit firms, that at least after the TCJA still expressed substantial uncertainty, okay? We're going to find that these firms basically don't invest any differently than the firms that were not expected to benefit as much from the TCJA. So I'll get back to this design a little bit more here shortly. Our final finding is, again, going back to the variation, we're going to explore the differential response, investment response to these expectations across domestic and multinational firms. And what our evidence is going to suggest is that domestic firms respond to expectations by adjusting the level of their investment. So again, if the sentiment is higher, they invest more. If it's lower, they invest less. Multinationals, on the other hand, because they have not just the option to invest in the US, but also to move to other jurisdictions, we're going to find that they're going to respond to these expectations in the US by adjusting the location of their investment. So, for example, if for some of the multinationals that were maybe uncertain about tax policy in our setting around the Tax Cuts and Jobs Act, we're going to find that they're going to increase their investment internationally outside of the US and vice versa. Okay. So these are the 4 high-level findings. In terms of the contributions that we think that our paper makes, on the tax research side, we think that the big takeaway is there's value in measuring and incorporating these tax policy expectations in the analysis of tax policy. They seem to matter, and they seem to vary in ways that maybe were in counter to the conventional wisdom. For policymaking, our results suggest that these expectations that are created by these certain legislative habits, like sunsetting, could have real economic effects to the extent that they impact firm investment, as our results suggest. And then finally, the expectations that are created by changes in tax policy could impact the extent to which those tax policies affect firm behavior. So that's on the tax research and policy side. On the other research side, we do think our paper has some implications for the general literature on measuring firms' expectations regarding policy, which, again, as I mentioned earlier, it's mostly about monetary policy, using surveys to assess inflation. So again, we're going to extend this literature, which again was on monetary policy, to fiscal policy. And then we're also, we think, introducing this approach that has some advantages over survey-based methods. Finally, we think our paper is relevant for this literature that's looked at policy uncertainty and investment. Again, a number of these papers use like elections as a setting and assume that uncertainty increases prior to the election and is resolved afterwards, and we're showing that's not necessarily true. The other thing is that these papers, generally speaking, don't think about the first moment of policy expectations, and that's going to be something we're incorporating in our analysis. Cool. So again, very briefly, thinking about the setting. So we're going to be focusing on the 2016 presidential election. There's a couple of nice things about this setting, at least for the purposes of studying our research question. One is that this election result was quite unexpected. Most commentators expected that the Democratic candidate, Hillary Clinton, was going to win. And so Donald Trump's eventual win was quite surprising to many observers, including firms, and you can see them discussing that in their conference calls. The Trump campaign itself was heavily based on tax reform. So he was promising to cut the tax rate. So we have a setting here where there was some uncertainty, and then the uncertainty was resolved, and you could expect from that uncertainty resolving that something might happen with tax policy. Now, even though Trump campaigned on tax reform, his actual policy was quite vague. I think it was a 1-page or 2-page tax policy. There were also some competing tax reform proposals in the House. And then there was also a very thin margin for the Republicans in the Senate. So even though there was this election outcome where the Republicans had all 3 chambers of the government, the legislature and the executive branch, not entirely certain what was going to happen with tax policy at that time. Now, moving forward to the Tax Cuts and Jobs Act, this was passed a year later in 2017. As I mentioned earlier, it was the largest, most substantial change in U.S. tax policy since 1986. The major highlight provision is that it lowered the corporate tax rate from 35% to 21%, so a 40% cut, quite substantial. But even then, some had discussed that there was uncertainty even after this tax policy had been passed. So a significant aspect of that uncertainty was that the whole process, legislative process, was quite rushed. It occurred from the beginning of November, essentially, and ended in December. So there was lots of implementation questions that firms had even after its passage. And then there was a question of whether or not Trump, because the government at that time was particularly unpopular, was he going to be reelected, and could things change in the future? Could this be overhauled completely? And as it turns out, he did not win the next election. And so there's still some potential that uncertainty remained even after this reform was passed. Okay, so again, what we're going to do is we're going to look at how our measures, expectation measures, behave around these 2 events. But before doing that, what we did is we went and looked in the conference call just to see what were firms talking about around these 2 events. And sure enough, there's lots of discussions of tax policy around the election and around the Tax Cuts and Jobs Act. So I've just got some excerpts here, some examples. We've got some more in the paper as well. And in the online appendix, we have a whole section with about 20 of them. So again, here we're just showing you some examples of things that firms talked about. So the one I want to highlight here from regarding uncertain for Exelon Corp, the CFO saying no tax legislation has been introduced at this time, so we don't know what exactly is going to happen beyond the short description of the Trump plan, which is again a generous description because I think it was like 2 pages, or the House blueprint. So they're saying, hey, we don't know what's going to happen, which means we can't quantify it. We can't start acting on this tax reform. So that there's this uncertainty in this post-election period about what was going to happen. Jumping forward to the Tax Cuts and Jobs Act, again, we can find firms talking both in terms of the first and second moments of these expectations. So, for example, the Coca-Cola Company, their CEO said, hey, many of you have been asking about how this is going to impact our business. We think that this is encouraging going forward. We think it's going to make the U.S. more attractive for investment. It's going to spur growth, and we expect that this is going to accelerate our investments going forward. That said, there's other quotes here that indicate that even post-TCJA, there's still uncertainty. The one I find most interesting is the IDEX Corp. Their CEO says, as the IRS continues to interpret tax reform, we can see more variability in taxes. We did spend more in understanding the tax code. It's pretty clumsy as is. As you know, they rolled it out with 0% guidance, so we've had to expedite our understanding of that. So just kind of referencing that this expeditious legislative process potentially created uncertainty for some firms about how the tax reform was actually going to impact them. Okay. Those are anecdotes, though. And so again, our approach is to try to quantify these things. And so what we've done here in figure 1 is we've plotted our first moment measure, tax policy sentiment, the average value in each quarter across our sample in the time series. And what you can see is that in the run-up to the election, it's pretty much flat. And then even after the election, there's a small bump, but you don't get a real large spike in sentiment until the passage of the Tax Cuts and Jobs Act. So again, saying that firms, even after the election, thought things could be good, but it was not really until the Tax Cuts and Jobs Act was realized till they say, okay, this is a positive thing for us going forward in terms of tax policy. Jumping to the second moment, what we find is relation again sort of flat in the run-up to the election, and then a spike after the election. So again, what's interesting here is this contrast with that prior work that assumes that certainty should be high prior to the election and then reduced afterwards. What we're showing here, that's really specific to the context of the election, because in this election, it was the expectation is that there was going to be basically gridlock in the US government. And then all of a sudden, the Republicans had total control of government after the election. And now we do, oh, something's going to change. We don't know what it is, but something's going to change. The other thing I want to note about the time series here is in quarter 1, 2018, so this is the quarter after the Tax Cuts and Jobs Act, there's not really that big of a change in tax policy uncertainty. So again, suggesting that while eventually the uncertainty was resolved, in the immediate aftermath of the TCJA, some firms still had some uncertainty over tax policy. Okay. So that's the on-average measures. The measures that we're primarily going to work with in our paper are these event-induced measures. So what we're going to try to do is try to, for each firm, quantify the extent to either the election or the Tax Cuts and Jobs Act led to a change in that firm's expectations. So the way we're going to do that is we're going to measure those post-event expectations, and we're going to compare it to a pre-event baseline where both of these things are firm-specific. So just, again, trying to say the pre-event baseline will be the quarters prior to the election, and say this is the baseline expectations they have, and then looking at the delta to what the expectations change to after these events. Now, we're not going to just use the quarter right after these events. We're going to be a little bit more agnostic about when firms will actually talk about these expectations in the conference calls. There's a couple of reasons we do this. One, especially for the election, for most firms, the quarter after the election was their fiscal year-end quarter. So maybe that lots of things happened in that year that they need to discuss in the conference call, and that crowds out a little bit the discussion of these expectations. And also just the timing of the conference calls can vary as well. So again, some firms had their Q4 2016 conference call before the election, some had it after. So what we're going to do is we're going to look at a short window after each of these events and look at their conference calls, and we're going to take the highest value across our expectations, and we're going to say that is the event-induced, the peak event expectations, and then we're going to compare this to this benchmark. So using these event-induced measures, we're going to document a couple of facts, mostly that these expectations are firm-specific. They vary a lot across firms. So what we've done here is we've done a variance decomposition where we've regressed our measures on a variety of fixed effects, state fixed effects, sector fixed effects, and sector times state fixed effects. And basically what we find is these fixed effects don't seem to explain a lot of variation in our measure, meaning that the remaining variation is coming at the firm level. So for the tax policy sentiment, roughly 3/4 of the variation in our measure appears to be firm specific. And for the uncertainty, it's around 67, 68%. So again, lots of variation across firms. The next thing that we did was we just plotted these measures by quartiles and then took the highest value in each quartile. And what stood out to us here is that basically these measures seem to have fat right tails. So what I mean by that is there are a number of firms that don't seem to have very large values, event-induced expectations for either sentiment or the tax policy uncertainty, but then some firms have very high values. So they talk about it a lot in their conference calls. So again, if you just look at the fourth quartile here, their average values are significantly higher than the other quartiles. We also see that same pattern for the Tax Cuts and Jobs Act, where again, for most of the other quartiles, these measures are relatively flat and then big spikes for the ones at the right tail. So again, the way we're interpreting this is that, again, some firms, for a lot of firms, the expectations are sort of similar, but then some firms are really sensitive to expectations around these settings. So going forward, what we're going to do is we're going to focus on these firms in that fourth quartile and compare them to the other firms and see if they behave in a different way. So again, before going to the investment results, this descriptive results, the big takeaways here, these two events did shape these expectations, and these expectations vary significantly across firms, which we think is a contribution. So for the remainder of the paper, what we do is we look at investment. We're gonna first look at the direct effects of these expectations on investment, Then we're going to explore how these expectations may have shaped the investment response to the TCGA. And then finally, we're going to compare the impact of the expectations on investment between domestic firms and multinational firms. So just briefly, the regression design we're going to use, investment capital expenditures is going to be our investment proxy as our dependent variable. And then we're going to effectively kind of run a difference in difference specification, where we're going to say, all right, our high tax policy sentiment firms, those fourth quartile sentiment firms, and the high tax policy uncertainty firms, we're going to look at their investment before and after these events and compare them to the similar change for the other firms. So across our two settings for the election, we're going to be comparing the 2014 through 16 period, the pre-period, to 2017 as the post-period for the election. And for the TCGA, we're going to be comparing the 4 years prior to the TCGA, 2014 to 2017, to the 2-year period after the TCGA. And we're going to cut off in 2019 to avoid the impacts of the pandemic. We're going to include a lot of controls and fixed effects. I'll talk more about the controls in the next slide. And we're going to put both of these expectations measures, the sentiment and the uncertainty, in the same model, because as it turns out, they're correlated, positively correlated in our setting, but they're going to have, as it turns out, differential impacts on investment. So it's important to account for both of them at the same time. In terms of controls, the one that I want to most focus on is that we're going to try to control for the firm's observable tax-related characteristics. So the goal here is to say, hey, controlling for the things that most people can observe from the financial statements, like tax expense, foreign sale, deferred tax liability, does the expectations have incremental explanatory value for investment? We're also going to control for some uncertainty and sentiment over other policy types, and then a variety of determinants of investment documented in prior research. All right, so our main findings here in Table 3, looking at the election, the key takeaway is that we find a very strong, robust association between tax policy uncertainty induced by the election and investments. So specifically, firms with higher tax policy uncertainty after the election reduce their investment. We find this is materially important. So over the year, it's about a 13.5% reduction for these high TPU firms, an investment relative to the mean. It's actually pretty comparable to some prior research, let's say Yen's, that looks at the reduction in certainty around elections and finds it's about a 4% reduction, a quarterly reduction, which aggregated would be 16% of the year. So we're sort of in the ballpark of what prior research finds. Interestingly, we don't find that the sentiment seems to shape investment. Maybe it's because the sentiment doesn't spike yet, that much after the election, or maybe it's just the uncertainty is the dominant effect at this time period. Yes, Jochen.
I have one question regarding the controls. So
Yeah.
you control for tax loss carry-forwards. And the first question is, why do you think that is something like a confounder that affects the tax policy expectations and the tax rate, and by this way, the investments, or is it just to increase precision? And the second question is, how about these recent losses, like in the direct paper, 5 years recent losses that have been shown to be a bit more precise than tax loss carry-forwards?
Yeah. No, this is a great question. So again, the goal of all the tax-related variables is what we're trying to say is that the expectations we're capturing are not simply a reflection of the observable tax characteristics, that it's adding something more to the model. Now, for the loss variables in particular, I'm remembering the referee process. This was suggested by one of the referees, the referee who was concerned about our inclusion of loss firms, because we include loss firms because most investment papers do include both profit and loss firms. But in the tax literature, sometimes we throw out the loss firms because they have sort of different tax planning incentives and abilities. So the inclusion of the loss variable was just to try to account for the difference between the loss and the profit firms. We do other approaches. So for example, you can see in column 6, we're actually going to include a loss indicator over 3 years. And then in some of our robustness tests that we talk about in the appendix, we also just control for losses in different ways. I don't remember if we did the specific one that Dyring suggested, the 5-year, I think it was like cumulative loss, but we explored lots of different ways in the paper to account for these losses. And again, the real idea is that we do think these things can shape expectations and shape investment, but what we want to be able to say at the end of the day is that the expectations are telling us something more about the firm's investment, incremental to these observable tax characteristics.
Thank you.
Yeah, of course. All right. And thank you, Jakob, for reminding me. We have all these other specifications here that we find our results are robust to, that I forgot to talk about. When we go to the Tax Cuts and Jobs Act, here we're going to find both moments matter. So uncertainty leads to a reduction in investment. The sentiment leads to a higher value in investment. Again, both of them tend to be economically meaningful, as indicated at the bottom of the slide here. So again, the big takeaway from these first two tables is that the expectations, at least as a directly, seem to have an impact on investment. So what we want to do next is a little bit more nuanced. Here, what we want to do is we want to specifically focus on the firms that you would have expected based on their observable tax characteristics, that they would have benefited a lot from the Tax Cuts and Jobs Act. And here we're going to rely on some prior work that's quantified the extent to which firms probably benefited from the 2016 election in the TCJA. They're pretty intuitive. So again, we're going to classify a firm as a high TCJA benefit firm if it has a high effective tax rate, with the idea being if you had a high effective tax rate before the TCJA, you're going to be benefiting a lot probably from that large statutory rate cut, versus a firm that's already paying a very low tax rate, let's say a 5-10% tax rate, probably because they have operations in foreign jurisdictions, they're going to benefit less from this tax cut because their tax payments were already low. We're also going to use high deferred taxes, again, deferred tax liabilities. Domestically oriented firms, because they didn't have these income shifting opportunities, were also more likely to benefit from the TCJA. And finally, there were some multinational firms that probably benefited, those that had these really high amounts of permanently reinvested earnings that were kind of stuck abroad that they couldn't bring back to the US because they would owe the large US tax on them. They probably also benefited as well. So again, what we're going to do is we're going to synthesize these into a particular measure that says, all right, you are a firm that I think probably benefited a lot from the Tax Cuts and Jobs Act. So what we're going to do next is see, did those firms invest more after the Tax Cuts and Jobs Act? And the answer is yeah, which is good. So what we're showing here is the difference between the investment of the high TCJA benefit firms and other firms in event time around the Tax Cuts and Jobs Act, which happens in 2017. So what you can see here is that they didn't these firms didn't invest differentially relative to other firms prior to the TCJA, but then their investment increases substantially after the Tax Cuts and Jobs Act. Okay. So again, these firms were probably going to benefit. They seem to benefit because they invested more. Our real question is, did the expectations determine the extent to which these firms invested after the TCJA? So what we're going to do now is we're going to implement a triple difference in difference design, where we interact the high TCJA benefit times post variable with our TPS and TPU measures. And here's what that looks like. So what you see here in the middle line, sort of the dark gray line, is this is the average high TCJA benefit investment response for firms that didn't have either high sentiment or high uncertainty. So they do seem to invest after the Tax Cuts and Jobs Act. The blue line, though, shows the investment response to the Tax Cuts and Jobs Act for these firms that also had high tax policy sentiment. And what you can see is that their investment response effectively doubles. So again, the firms that felt very positive about tax policy after the TCJA, they tend to invest twice as much as the average firm. So the expectations seem to matter. Where it gets even more interesting is looking at the bottom line, the light gray line. These are the firms that you would have expected to benefit from the TCJA because they had high effective tax rates prior to the reform, or they were primarily domestic, and thus they didn't have these income shifting opportunities, you would have expected them to invest a lot, benefit a lot from the reform, and invest a lot afterwards. But this gray line are the firms that indicated after the TCJA that they were still uncertain about tax policy. And what you see here is their investment response is indistinguishable from firms that were not expected to benefit from the TCJA. So basically, they don't seem to show an investment response at all. So just showing that the takeaway here for us is that the impact of a tax reform on investment can vary itself by these expectations. And potentially one reason why we see heterogeneous responses to a specific tax policy that ostensibly should affect all firms in the same way could be driven in part by these variations in these tax policy expectations. And then this is just that in table form where you can see the doubling of the investment response and the with sentiment and the undermining of the investment response related to uncertainty in numbers. Okay. All right, so for those main investment results, we do lots and lots and lots of robustness. I think our online appendix maybe is, I want to say it's got to be close to 100 pages. So we've got a lot of that stuff there. We talk about some of it in the paper, a lot of stuff. But I really want to, again, just summarize what we take away from the investment results. And then before I get to the multinational things to wrap up, again, the big takeaway, expectations matter in terms of investment. They have material effects incremental to these observable characteristics that you can get from financial statements. So we think this is consistent with the critique talked about in the Hindustry and Shrebialayev paper. Those latter set of results I talked about, we interpreted as saying tax policy can affect firm behavior via its impact on these expectations. So potentially the uncertainty that some firms had even after the TCJA could have been a reason why they did not increase their investment after the passage of the tax reform. And then finally, researchers that are interested in these expectations should account for both of these proxies because they're positively correlated, but they have differential impacts on investment. So that leads me to our final set of results where we compare the domestic firms and the multinational firms. So the intuition that we have here is that the domestic firms should be strongly affected by tax policy expectations in our setting, because the setting we're looking at is a U.S. setting. The expectations are primarily that are changing here are primarily about U.S. tax policy, and domestic firms are, by definition, entirely subject to U.S. tax policy. Multinationals, on the other hand, it's a little less clear to us. Certainly, the firms we're looking at are U.S.-based multinationals. They should be affected in part by the tax policy expectations of the U.S., but they're also not constrained only to invest in the U.S. They can invest abroad as well. So it's less clear what we're going to find there. We think this is an important distinction to think about because the TCJA was not only intended to motivate or to increase investment, but also to encourage U.S. multinationals to bring investment back to the U.S. to ensure this investment. So basically what we're going to do is we're going to take the main model for the TCJA election where we looked at the high TPS and high TPE firms and how they invested differently around the TCJA. And we're just going to separate out that response in terms of whether the firm is a multinational or domestic firm using several different definitions of a multinational firm that have been used in prior research. And here's what we find in table 6. So you can see that our main results pretty much still are there. So the election, tax policy uncertainty drives down investment. Around the TCJA, we're going to find that sentiment increases investment, uncertainty reduces investment. But each of these results is substantially weaker for the multinational firms. So for example, looking at the election, here, when we do the triple interaction with multinational, we find that a positive coefficient with uncertainty, which then when you add it together with the main effect, basically there's a substantially reduced impact of uncertainty around the election on the investment of multinational firms. Similarly, for in the TCJA, we find that, for example, they exhibit a weaker positive investment response to sentiment. Okay, And again, this is best shown, I think, in the joint effects at the bottom of the table. So again, the takeaways, the tax policy expectation investment sensitivity, it's weaker for multinationals relative to domestics, and in an economically important way. So again, for uncertainty around the election, the multinationals' response to uncertainty is 58% lower than that of the domestic firms. Around the TCGA, the response to sentiment is almost 100% lower for the multinationals relative to domestics. So that leads to the final question we tackle in the paper, which is, why is this happening? Why are the domestic firms or the multinational firms not just responding as strongly to investment? Well, one possibility is that domestic firms, again, are shifting or are changing the level of the investment, whereas multinational firms, as I mentioned earlier, they have another option. They don't have to just change the level of investment. They can change the location of the investment, keeping the aggregate investment the same. Now, this is really challenging to measure with publicly available data in the US, so we're going to try to triangulate it with a couple of different approaches. First, by looking at the investment behavior of the European subsidiaries of US multinational firms, and then employing a sector-level design using BEA, Bureau of Economic Analysis data. And the good news is that both of these approaches are going to point us in the same direction. So when we go and look at the European subsidiaries, we're going to find that when the multinational parent was more positive about US tax policy, they invest less in their European subsidiaries. When they're more uncertain about the US tax policy, they invest more in their European subsidiaries, which is consistent broadly with these US subsidiaries shifting investment to their US subsidiaries or the European subsidiaries or away from the EU subsidiaries based on their US tax policy expectations. Now, of course, the drawback here is that we can only observe the behavior in the EU subsidiaries because of data availability. So the next thing we're going to do is we're going to use a sector level approach with BEA data, because that data provides us the ability to measure, at least at the sector level, whether the investment's happening in the US or in a different country. And again, we're broadly going to find the same result, which is that when the sector is generally more positive about US tax policy, they're going to invest less, they're going to tilt their investment away from the foreign countries. They're going to have less investment in foreign countries relative to the US. When the firms are more uncertain about tax policy in the US, they're going to tilt their investment towards the foreign countries and away from the US. So again, both of these results, we think, are broadly consistent with this idea that the domestic firms, they change the level of their investment, but the multinationals, they respond to the expectations by changing the location of their investment, which again, we think this is relevant for policymakers because, again, one of the key goals of the TCGA was to encourage this onshoring, and we're showing that really the onshoring is affected at least in part by these tax policy expectations. All right. So that's the paper. Again, overall, what we're trying to do is to study and measure these tax policy expectations and to explore whether and how they shape investment around a tax reform. Again, to kind of restate the findings first, we do find that these events shape expectations and honestly, what we find is interesting ways. Sometimes they run counter to the assumptions in prior work. There's lots of variation in these expectations across firms, which again, prior research tends to assume that they're homogeneous across firms. They seem to have material impacts on investments in ways that could potentially confound causal inferences if you studied investment around a tax policy change and didn't incorporate these expectations. And then finally, these expectations, their impact on investment differs a lot across firms. And the one that we focus most in the paper is this multinational domestic distinction, but we have other distinctions that we tackle in the online appendix. Okay. So again, the big picture thing I'd like you to take away is that these expectations matter. They affect investment. They can drive heterogeneous tax policy responses. For policymakers, they may be creating these expectations via their legislative habits, and that these could have real economic effects. So again, the big picture thing is that it's important for us as academics and policymakers to think about, to measure, and to incorporate these tax policy expectations when thinking about tax policy. Yeah, that's the paper. Thank you. Happy to take any questions. I know I'm kind of at the time, but I'm happy to stick around for a few minutes and chat.
Thank you very much, dear Professor John, for your contribution and your effort. It's really an excellent presentation and excellent viewer. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question. William?
Yeah, yeah, William.
Hey, John, very interesting. When you guys measured, let's say, for example, you looked at 2,000 firms initially, how many of those roughly were you able to actually pull tax text from their earnings calls? Meaning, how many actually were talking about tax policy?
That's a great question. I'm not sure of the specific number. So I can tell you that not all firms talk about tax policy in their conference calls, which kind of makes sense. I mean, there's lots of things to talk about in these quarterly earnings conference calls. Tax policy is just but one. It's one that I'm super interested in, but not all firms are interested in or it's relevant for them. Again, the firms, we find that at least in some of our settings, at least a good chunk, like up to a quarter, do talk to a substantial extent about tax policy. Now, we actually view that idea that most firms maybe don't talk about tax policies. It's kind of a good thing in that what we think that means for our measure is that our measure is going to pick up tax policy expectations for a given firm when it's really important for that firm. And if it's not really important for that firm, they're not going to talk about it. But I do want to say that, that is a drawback of our approach relative to a survey, for example. So for a survey, you could go out for all 2,000 firms and elicit their expectations, and where they stand for each of the 2,000 firms. Versus in our setting, for some of them, they may not talk about tax policy, we may not know. But again, if the end goal is to kind of think about what the material impacts are of the survey, I may be one of those executives that expresses a view of tax policy, but it's not really that important for our firm. And then when I go to the conference call, I don't talk about it, and that may be an advantage of the conference call approach. So again, I don't have a specific number, but that was kind of our thinking as we went through and analyzed and saw that some firms do talk about it a lot, some firms don't. I don't know if you found that helpful, but
Yeah, no, I think it sounds like you're saying you moved away from the assumption sort of construct and more to a firm specific.
That's right. Yep. So we're thinking about this really at the firm level. What are their expectations and are they meaningful for them? And if that's kind of what you're after, the conference call setting could have a measurement approach can have some benefits. For other questions, the survey approach is going to have stronger advantages.
Cool. Thank you.
Yeah, of course. Thanks for the question.
Yeah,
So I think Yakin again. Yeah.
Okay, thank you. It's a bit complicated question. So I think you argued very convincingly that tax policy expectations are something like a confounder if you look at the influence of the tax rate on investment. I agree. And you have politics in the background that affects tax policy expectations and the tax rate like simultaneously. On the other hand, if you analyze tax policy expectations, then the tax rate is the confounder. So it goes in the other way too, I think. And having said that, Mohammed, can I share a screen for that? Is that possible? Okay, I'll try to.
All right, I'll stop my sharing so that you can.
I'll try.
Yep. So in principle, I agree with what you're saying. Yes.
So it's like that. So you have the tax rate, and on investment expectations are founder. And if you say,
uh-oh, is it just me or is he breaking up? Oh no. You're muted. You're muted, Yakin.
Yeah, the connection just went down. So it's on the other hand, having said that, by looking at the heterogeneous effects for different firms, is that like controlling for the tax rate, or?
That's one way to think about it. So I mean, I agree in principle with your point, which is I think if you're solely, I think most of the literature is interested in like the tax rate or the actual tax policy. And so that's why we think then it's thinking about the expectations can be very valuable. But we agree with you that that if you're interested in the expectations, thinking about the actual tax policies out there and in place, which again, I think our paper suggests they impact the tax policy and they also impact, they impact expectations and they also impact investment. So clearly then if you're interested in the expectations and investment relation, that's an omitted variable. So again, in the specifics of our paper, that was again one of the primary motivations for us controlling for these observable firm level characteristics. So for example, you could imagine that a firm, and we find this, and some of the descriptors that we just didn't have time to talk about in the presentation, that firms that have higher effective tax rates tend to express lower tax policy sentiment. When you're paying a lot of taxes, you're less happy or less positive about the future about the tax policy. And sure enough, those firms also will exhibit lower investment, right? So again, exactly arguing your point. And so that was the motivation for both focusing on that heterogeneity, as you mentioned, to controlling for these observable characteristics. And also when we do that analysis where we focus on the high TCJA benefit firms, we're really now, the goal there is to laser focus in on firms that had a very similar set of tax characteristics that made them likely to benefit the TCJA, and then see then even within that group, the expectations matter in terms of the investment. So I totally agree with your point. We try to incorporate some of that into the paper.
Thank you.
Yeah, of course. And so I see we have one more question.
Yeah, Hanan.
Yes, hi, Dr. Muhammad. Hi, Professor John.
Hi.
Thank you for your informative presentation and excellent one. I have a question. It's related to the last discussion, I think. It's what is the best scenario to attract the multinational corporations and encourage domestic one?
So can you say that last part one more time?
From your opinion, what is the best scenario to attract the multinational corporations and encourage the domestic one?
Got it. So if I had to advise policymakers based on the way I'm interpreting your question is based on the results in our paper, if I had to go to Congress and say, here's the advice I'd give you in order to encourage your objectives, which is like, let's have higher investment by domestics, but also to encourage the multinationals to bring back investment to the US. That's kind of what you're asking.
Yes.
Yeah. So
Thank you.
yeah, that's a great question. So again, what my pitch to the policymakers would be, you focus a lot on the specifics of policy, like tax rates, taxation of foreign earnings. So again, in the US around the TCJA, it used to be the US would tax foreign sourced earnings, but then after the TCJA does not for the most part. So that you focus on these policies, but lurking in the background, the things that you do, both in terms of the actions you take prior to passing a policy and in the aftermath of the policy, is impacting how firms think about what policy is going to be like going forward. And that really matters for firms making capital investments, because these are long-lived investment. Firms are not thinking myopically about the tax rate today or the tax policy today. Their investment is something that's going to last 10, 15, 20 years. They need to think about tax policy over that entire time period. So my suggestion to policymakers would be, so this is a really great question, because in the US, we're probably going to have another period of policy uncertainty after this next election, would be to don't rush the legislative process. Try to spell out the details of the tax policies and how they will be implemented and interpreted by the relative or the tax authorities like the IRS. Try to spell out these details. Give firms a long road to adjust to these details, such that then once you pass the policy, firms have generally speaking a good idea of what the policy is going to be and how it's going to be interpreted. And then furthermore, one thing that happened with the TCJA is that again in the process of it being passed, there were things that needed to be fixed later, parts of it that were kind of like broken, and
Yes.
so because then the broken parts sometimes are require legislative approval, which the government may change, which again in the US, 2 years later, the government control changed. This uncertainty about, what's this policy going to be? Is it going to be fixed? How's it going to be interpreted? Can undermine the intent that the policymakers have with lowering a tax rate or encouraging this onshoring. So again, that would be my primary advice, is to avoid these legislative habits. Like, hey, let's get through this really quick. Let's get something out there and pass it just so we have a policy win. Let's try to do it on a more solid basis, spelling out the details, because I think that it increases the likelihood that that policy will remain permanent going forward. That would I think be the main advice I would give. I would also give, the US not to use the
answer. Thanks for your detailed answer. Thank you.
Yeah. I mean, the other thing would be the sunsetting proposals, not to pass tax policies that will then definitely expire within a given period of time. But I think in the US, there's little hope for that, because it's part of our legislative making process. There's some quirks to it that the policymakers sort of let's say game by doing those kinds of sunsetting policies. So that would be another one I would advocate for. But again, I think in practice, that one's going to be tougher for them to adjust.
Thank you for your detailed answer, and see you in Egypt soon, inshallah. It will be very beneficial for us.
That'd be amazing. Yep.
Thank you.
Thank you.
Are there other questions? If you don't have any questions, you can open and ask your questions. Thank you very much, dear Professor John, for your contribution and your effort. It's really an excellent presentation. Thank you very much, everyone joining us today. And thank you very much, dear Professor John, for taking the time to present to us. It's been really appreciated. Thank you very much.
Yeah, thank you so much. Thanks for the questions and for everyone taking time out of your day. And thank you for the invitation, Mohammed.
Yeah, and I hope you are soon in Egypt. You are very, very welcome.
Yes, that would be excellent. I look forward to that. Take care, everyone.
John,
Thank you.
can I share the screen once more?
Sure.